Well, look at how far we've come. Even Mohnish has turned his back on Alibaba. Are we truly approaching the bottom of the barrel for Alibaba stock? I'll let you be the judge. So just 2 weeks back, Mohnish actually uploaded his talk with the CFA Society of Mexico on his YouTube channel. As always, Mohnish provides invaluable content for free on his channel, and he usually grounds his explanation with a myriad of different examples, making it less theoretical and much more relatable. So in the 15 minutes or so talk, Alibaba was briefly mentioned shortly after the opening section. So in fact, the discussion only lasted for a minute or so. I will play the short extract here.
Well, I would say Alibaba is a great business. Got into the crosshairs of the Chinese Communist Party. That's usually not a good thing. They have some very strong moats. They have great management. Probably the business does well. Beyond that, I think you need to do your homework. And one thing I would just generally say is that given how large Baba is and how long a run it has had, for the length of period it has that run, it would not be my top pick, or maybe even my fifth or seventh pick. So I think that there should be a lot of other businesses that should be a lot more attractive with probably better economics than Alibaba.
You know what should be everyone's top pick? The like button, of course. How can you forget about it? Get the highest return on investment with the like button today. Also, this video is sponsored by Webull. So I know many of you smart investors out there have already taken advantage of the different sign-up rewards in the past 3 months. But in case you haven't, Webull recently leveled up their game again. And from now until the 30th of September 2022, every new sign-ups will get up to $130 USD worth of Tesla shares. So I'll leave the link and instructions down below. Essentially, you just need to deposit at least 2,000 Singapore dollars and execute one buy trade of a stock or ETF and one option, and you'll get an 8% ROI from the sign-up rewards. Definitely a lot better than Alibaba. So I'm currently using Webull for my 15,000 portfolio as well. So don't let this guaranteed deal get away. Link in the description box. Anyway, Mohnish's commentary can be segmented into 2 parts. So the first part would be about Alibaba's business and the environment it's operating in. And the second part is actually revolving around Alibaba as an investment opportunity. So let's talk about Alibaba's business first. So I think I don't really have much to add. Anyway, he claims that they have a great business, it has a strong moat, great management, and the business will probably do well in the long term. But they just kinda got in the crosshairs of the CCP, which might become a rather sticky issue, and is usually not a good thing. So I generally do agree, but I think for many long-time viewers here, I've also laid out the case that CCP's involvement might not necessitate a destruction of the entire industry, even though there are evidence that supports both sides of the argument, whether it destroys or whether it doesn't. Beyond that, I think as a fellow shareholder, you really need to do your homework. So from understanding the business itself and the black box of an operating environment China is in today, to having a position about the different geopolitical tensions and how it will come bite your ass when you least expect it. But given the many exciting developments around the company thus far, it probably presents you with an opportunity like never seen before. However, I'm not saying that it's risk-free. Similarly, many other investors can also argue that such inefficiencies and also more importantly mispricing can be extracted from markets like Russia, Argentina and Turkey in such crazy times of sanctioning and rampant inflation. I do agree, but I guess it ultimately voices down back to your investment objectives and what sort of risk you're comfortable taking. Only you can make the assessment yourself, so don't try to outsource the responsibility to the internet. So I also find it rather perplexing when Mohnish actually made the comment that Alibaba getting into the crosshairs of the CCP will probably result in something bad. But I believe he switched out of his Alibaba position for Prosus, which is basically a proxy for Tencent. The last I checked, Tencent is probably in the crosshairs of the CCP as well. Or was I just delusional? Anyway, Prosus was trading at a steep discount, probably allowing Mohnish to reap some sort of margin of safety, and it has recently reverted back to its mean because of a share buyback program that they enacted. And I'm not too sure if Mohnish is still in his Prosus position or not, but you probably get my point. Next, Mohnish then asserts that given how large Alibaba is and how long a runway it has had, it would not be his top pick, maybe not even his 5th or his 7th pick. Funny enough, I agree with that statement too. With that, I'll see you in the next. Okay, jokes aside, I think it's fair for him to make such a statement. Similarly, if you were to look at the big techs of today, your Apple, Microsoft, Amazon, and Google, would you expect them to be an easy 5x or 10x from today's valuation? I think it will be a rather tough call, even though many of us might have a very high level of conviction in the proven business model. So a 5x from Apple's valuation today would mean that it will be trading in the north of $12 trillion. Possible? Yes. Probable? I don't know. Maybe if the USD depreciates at the rate of the Venezuelan dollar, then I guess we will reach 12 trillion valuation in no time. Anyhow, if you were to look back at Alibaba, they have a current trailing 12 months earnings per share of around $2.32. At its peak, they had an EPS of $9.32 back in 2019. So there was a whole lot going on in the last 2 years. So don't get me started on it. So now, let's presume that the quote-unquote correct EPS is somewhere in the middle. Maybe let's take $6.50 per share for example. So if you want Alibaba to 5x from today's valuation, that would mean that the stock should be trading at least $400 and above. And if you were to apply an average PE multiple of 20 times, I don't think it's too much to ask. That would mean that they have to grow their EPS to around $20 per share. So 20 times 20 will give us $400. So quick math. Judging from Alibaba's EPS growth over the last 8 years, you have to be the judge of whether we can hit that milestone or not. Of course, past performance is definitely not indicative of future results. But the thought of being one of China's biggest tech giant reaching a $1 trillion valuation don't seem too far-fetched when Apple was near $3 trillion just last year. Of course, these sort of relative valuations when you compare big tech with big tech can be a rather dangerous way to value securities. So you should still base your decision on the expectations of how the business will perform and the cash flows that it will bring in for shareholders in future. So from Mohnish's perspective, these sort of returns don't excite him because he can probably pick a Turkish company growing revenues at high double digits that are trading at a PE ratio of 3 or lower than 3. So he can do that probably because that company is not only within his circle of competence, he is also comfortable with the different sort of risks being associated, like for example the geography of where the company is listed in. So for the rest of us, we should stick to what we know and what we are comfortable with. It might not be Mohnish's top 7 picks, but it is definitely in my own top 3, and it is based on my own risk-reward compass. What about yours? Leave in the comment section down below, and I'll see you in the next video, but more importantly, I will see you on the moon. Goodbye!